All right, let's talk about Hyperscale Data Inc. First things first, the market is closed for the weekend. As of the closing bell yesterday, Friday, November 14th, 2025, the stock ended the session at $0.28 per share. That was a rough finish, down $0.023 or 7.60% on the day. Now, when we see a 7.6% drop on a stock this cheap, the immediate reaction for many is either panic sell or see a massive buying opportunity. But the reality of this specific situation is far more complex than just high risk, high reward. What we're actually witnessing isn't just volatility. It's the market grappling with a fundamental disconnect between the company's ambitious narrative and its operational solvency. That 7.6% drop wasn't just noise. It was a delayed reaction to a filing that most online investing retail traders, especially those using the Robinhood app, probably missed entirely. This isn't a simple case of a growth stock taking a breather. It's a micro-cap stock flashing serious warning signs. The expectation, the story being sold on social media and forums, is that hyperscale data is the next big thing. You hear the name hyperscale, and you immediately think of the massive data center demand, the kind that fuels giants like NVIDIA stock. The belief is that this $0.28 price tag is like getting in on the ground floor. It feels like an asymmetric bet. People look at the performance of Tesla stock over the last decade and think this is how you find those multi-baggers. They see a low-cost entry point and assume the risk is capped, but the upside is limitless. This is the common narrative driving the speculation, the idea that a small investment here could lead to significant gains. But that's where the expectation runs headfirst into a brutal reality. The $0.28 price isn't a discount, it's a reflection of extreme distress. This 7.6% drop wasn't arbitrary. It correlates directly with an 8K filing from 2 days prior outlining a new round of convertible debt financing. For those new to self-investing, that's often just a fancy term for massive, incoming dilution. The conversion price on those notes is likely disastrously low, meaning institutional note holders are already positioning to short the stock, convert their debt to shares, and flood the market, pushing the price even lower. So while the Robinhood stock trading crowd is buying the dip, the professionals using interactive brokers are calculating the dilution and placing their bets against the company. This isn't an intelligent portfolio move, it's a gamble. This kind of high-risk play is the exact opposite of what automated services like Schwab Intelligent Portfolios are designed to do. Let's scrutinize that 7.6% move. Volume on the final day of trading was 4.5 million shares. That's actually below its 30-day average. This is significant. A sharp drop on low volume suggests it wasn't a mass panic. Rather, it indicates a gap down in liquidity. The sellers that showed up were determined, and the buyers simply stepped away. There was no bid support. This is the opposite of what you see in healthy stocks, like Apple stock, where dips are often met with significant institutional buying. Here, the institutions are absent. When you look at platforms offered by Fidelity or even the SoFi trading platform, this stock likely carries a high-risk warning if it's even recommended at all. The recent trading history is riddled with these traps. We saw a spike to $0.40 2 weeks ago, driven by a press release that promised synergistic evaluation of data optimization. That's corporate jargon for "we're thinking about doing something." It was pure air, yet it triggered the algorithms and the retail FOMO. That spike was aggressively sold off, and everyone who bought at the top is now underwater, contributing to the overhead resistance. This recent 7.6% bleed is just the continuation of that reversal. This isn't Investing Sites 101. This is advanced high-risk speculation. It's crucial to understand that managing an individual brokerage account with stocks like this is fundamentally different from using a Fidelity wealth management service, which would never touch this. Fidelity Brokerage might execute the trade, but they're not endorsing it. What about the macroeconomic picture? It almost doesn't matter for a stock this small. Whether the Fed raises rates or cuts them, Hyperscale Data's problem is internal. It needs capital, and it needs it now. Its survival isn't tied to the broader economy, it's tied to its ability to convince the next investor to fund its operations for another quarter. This is a stark contrast to the majors. When Tesla stock moves, it's about EV adoption, macro rates, and production numbers. When Hyperscale moves, it's about survival. Many investors using SoFi Invest are encouraged to look at SoFi ETFs or use the SoFi Robo-Advisor for diversification precisely to avoid this kind of single-stock risk. SoFi active investing platforms allow you to buy SoFi stocks like this, but the risk is entirely on you. Let's look at the players. Who is trading this? It's not the big mutual funds. It's not Fidelity mutual funds or most Fidelity ETFs. The institutional ownership is almost entirely vulture funds or market makers facilitating retail flow. The Robinhood fractional shares feature might allow people to buy $10 worth, but that just creates a wider pool of retail holders who will be left holding the bag. The Robinhood crypto crowd might be used to this volatility, but in the equity space, a sub-dollar stock heading towards a 7.6% loss on a Friday close often signals a grim weekend, with the potential for more bad news on Monday. The Fidelity mobile app and the Fidelity trading platform make it easy to buy, but ease of access is not the same as a good investment. The Interactive Brokers trading platform, favored by more advanced traders, provides tools to see the cost to borrow this stock for shorting, and I guarantee it's high, indicating strong bearish sentiment. The Interactive Brokers' fees are low, but the risk in shorting a penny stock is also immense, as it could be subject to a sudden, news-driven squeeze. This is a battlefield, not an investment. You need to understand the tools at your disposal, whether it's the advanced charting on the Interactive Brokers platform or the research reports available through Fidelity Investments. So what does Hyperscale Data actually claim to do? According to their filings, they provide next-generation data acceleration solutions for artificial intelligence workloads. The idea is that as AI models get bigger, the data bottlenecks increase, and their supposedly proprietary software and hardware architecture can speed that up. It's a fantastic narrative. It ticks all the boxes: AI, big data, cloud. The problem, they are competing in a space that includes NVIDIA, AMD, Intel, and every major cloud provider: Amazon, Google, Microsoft. These are companies with R&D budgets that are orders of magnitude larger than Hyperscale's entire market cap. The expectation is that they have a unique piece of tech. The reality is that they have produced very little in terms of verifiable, scalable revenue. Their last 10Q showed cash burn accelerating, with revenues that were, frankly, negligible. They are surviving on financing, not operations. Looking forward, the expectation for a stock at $0.28 is binary. It's either a 100x lottery ticket or it's going to zero. Many are holding on for that one big contract announcement that validates their tech and sends the stock soaring. They are hoping for a buyout. That is the bull case. But the reality sets a much grimmer stage. The most immediate risk is a reverse stock split. To maintain its listing, if it's even on a major exchange or just OTC, it needs to get its price back over $1. A reverse split, say 1 for 20, would achieve that, but it's a cosmetic fix. It doesn't solve the underlying cash burn. It often just provides a new, higher price from which the stock can continue to fall. The financing agreement we discussed is the real catalyst. It ensures the lights stay on for another quarter, but at the cost of the existing shareholders. The opportunity here is that they might actually have something. The risk is that you will be diluted into oblivion before you ever find out. This is where online investment strategy becomes critical. If you are using Fidelity or SoFi, are you using their research tools, or are you just chasing hype on a forum? A platform like Schwab Intelligent Portfolios is designed to build a balanced allocation, precisely to protect investors from the kind of volatility we saw Friday. Self-investing is powerful, but it requires this level of scrutiny. The interactive brokers account holders are looking at options chains and dark pool prints. The Robinhood app users are looking at a one-day chart. It's an information mismatch. This is why investment help is so crucial, even if it's just doing the deep reading of the S1 and 8K filings yourself. Investing sites can give you the data, but not the